Yes, okay. So yeah, we're looking at accounting, we're still looking at marginal absorption, costing and that. Obviously this is looking at management accounting. So remember, financial is summarized, management is detailed. That's the difference here. So all of these red chapters in the textbook looks at management versus those purple chapters, which was financial. It's a little bit different, but still same concepts apply. Okay, first thing we need to look at is make or buy decisions. The note here, they talk about an opportunity to purchase versus an opportunity to make. Okay, so we're trying to weigh up the pros and the cons. Which is better? Is making better than buying? Or is buying better than making? Here they said in order to arrive at a specific decision on whether to not purchase a product rather than rather to make the product, the manager should consider the marginal cost and revenues. There's the key words. Okay, so as a study note, you can say marginal costs and marginal revenues need to be analyzed or measured. You have to measure both. Marginal cost and marginal revenue need to be measured. Second bullet, a profit, inverted commas, / benefit needs to be determined. So what are the benefits of buying versus the benefits of making? That's what we're trying to look at. Okay, so a profit / benefit must be calculated or measured. But they've given me an example here of a sweatshirt manufacturer. So they're looking at, do we make our own sweatshirts? Or
sorry.
Is it not important?
No, it's okay.
Sure, okay. Do we need to measure, do we need to buy or do we need to make? Okay, we need to measure which is better. This sweatshirt manufacturer is determining what the costs are of producing the unit based on production. So we're looking at the profits. If we make and then sell, we're going to make a profit of 420,000. So let's put that as an example, e.g. decision to make okay, underneath this, we can put a few bullet points. You can see there's quite a lot of business here. Direct material, direct labor. Yeah, decision to make is the heading, example, okay. Underneath that, you can just say direct material, direct labor, and fixed costs, brackets, overheads. Okay, we know from business that fixed costs are generally called overheads. I'm just bringing some of that knowledge through here. Obviously, you're not going to be tested on detailed business-related stuff, but the accounting, the calculations, the workings that you need.
Direct material, direct labor.
Fixed costs, in brackets, overheads. Okay, I'm going to give you smaller numbers so we don't have such massive amounts. We can just drop off the thousands. We'll just keep it as like 12 or 2 or whatever. Okay. Alright, so you've got those three. Okay, for direct material, 2. Labor, 3. Fixed cost, 4. Okay, and then on the next line, sales revenue equals. $12. That's the sale revenue, 12. Right, so if I'm looking at production, I need direct material, I need labor, and I need overheads to produce the product before I can sell it. If I sell the product and sell the product at 12, so you can circle or like group those two. So 2 plus 3 plus 4. Group it.
These 3.
Yeah.
Okay.
Those 3. 2 plus 3 plus 4 equals 9. Just write down 9 next to that. And you can write a note costs. So it costs us 9 to produce shirts, okay, sweatshirts. If we sell those shirts, we can sell those shirts at 12.
So 9 is the cost.
9 would be cost, yes. 12 would be revenue.
Okay.
You can label 12 revenue.
Yeah, I've got sales revenue.
Okay, and then on a separate line, you could just say marginal profit equals 12 minus 9 equals 3 per unit. Marginal profit equals 12 minus 9 equals 3 per unit. Okay, so you have to do this calculation for the items that you're manufacturing. Okay, so we're manufacturing sweatshirts.
What does marginal profit mean?
Marginal means the next. So if I make another shirt, I'm going to generate 12 Rand or $12, and it's going to cost me $9 to produce. Okay, if we make more shirts and more shirts and more shirts, is our revenue going to go up or down? It's probably going to go down because now there's too much demand. Well, not enough demand for all your shirts. So let's assume as a manufacturer, we're going to produce 10,000 shirts. Okay, hopefully there's 10,000 buyers or more. If there are, we're not going to have a problem selling the shirts. Now what happens if we produce 1 million shirts and only 500,000 want to buy? We're going to have to sell those shirts at a cheaper price. Okay, so those things they don't really consider here because that's more the business side of things. But from an accounting point of view, how much do we produce? $3 per shirt. Okay, so if they want to sell 140 shirts, it'll be 140 times 3, which is 420. Okay, but we don't have to show that. The marginal is the important bit. Okay, so that's the example for the making. Then you can say, e.g., buying or purchasing decision.
Is this separate?
Yeah, this is separate. Okay, because remember, make is one decision. Buy is a separate decision. Are you going to do both? No, you're not going to make and buy. You're either going to buy or you're going to make. Okay, because the thing is, you want the shirt, you want the sweatshirt. It doesn't matter where it comes from, but we need the product to sell. Okay, so here, buying or making. Yeah, that's the question mark. This example is focusing on the purchasing, the buying. Okay, so buying, you can just say buying costs. Buying costs 9,8. Revenue is 16,8.
From the buy.
Yeah, 16,8. And the difference is what? 16,8 minus 9.8 is 7. So let's show that. Revenue minus buying or purchasing. It's kind of like sales minus cost of sales.
Yeah, 7.
Yes. Okay, but a business is still going to have to recover what? Its overheads. So when you're buying goods to sell, you're buying goods, so there's a cost price. Okay, this shirt costs 9.8. We're going to sell it for 16.8. What do we still need to recover? Fixed or overheads. Okay, so next line. Fixed costs still need to be recovered when buying goods. That's the only problem with buying goods. You still need to cover your other overheads. So yes, it might be easier or more convenient to buy a good to sell because it saves in terms of time and effort and production. You still need to cover overhead, so you need to build that into your costs, right? And the cost here we could just use 5.6. Okay, so what is 5.6? What is the difference? 7 minus 5.6 is 1.4. Okay, so 1.4 you can say per unit. $1.4 per unit. That would represent the marginal profit. I didn't tell you to write that. You can maybe put that in brackets here. Okay, so if those were the two options, option 1, make. Option 2, buy. Which is better?
Well, we don't have when we make it.
We do, the top bit. Decision
it's
to
the
make.
same thing.
It's two different sides.
Okay, so this was to make.
Yeah, two different sides of the same decision.
To buy.
So,
Okay, so if we make it, we get $3 per unit. If we buy it, it's only 1.4, so we rather make it.
Okay, so in this instance, so you can conclude, you can say, for this particular business, making goods to sell is slightly better than buying and selling. But it would depend on economies of scale. Sometimes it's cheaper to make your own goods. But if you're a big business, okay, your cost of production could be very low for every item you produce. Okay, it's like, for example, as an individual, right, would you want to bake your own cakes or make your own cakes? Okay, there could be a benefit for buying a cake that's made rather than having to buy the ingredients to make it. Right, but now if we've got a bakery, obviously making cakes would be cheaper than buying them. Right, if we had a bakery or if we had the right resources. Okay. And that's that. Okay, next bit. This is looking at choice between competing course of action. So when we say competing course of action, tables, chairs, and cupboards, are they all items of furniture? Yes. But now you need to decide on how many chairs versus how many tables versus how many cupboards. Okay. You don't really have to write too much. That's the only bit there. And then they talk about production capacity in there. Okay, so you can probably fit it in at the bottom. Just as a note, you can just say choices between competing courses of action. Okay, and it's really straightforward. Just think about time. Can you do more than competing? Compete, yeah, to compete.
Competing.
Choice between competing courses of action.
Choices between competing
courses of action. Okay, so it's really simple to understand. If we just think about what is it focusing on. So, a course of action means direction. So we're either going to go left or we're going to go right. Can we go left and right? No. Okay, you've got your drivers now. So when you're at the stop street, you can turn left, you can turn right. It's assuming it's a T-junction. Okay, you can't go both directions. It's impossible. And that's what they're talking about here. So, as an example, you can say a furniture business that's producing tables, chairs, and cupboards will have to decide how many chairs, how many tables, and how many cupboards. Okay, they can't produce all cupboards, all chairs, and all tables if they only have a certain number of resources. Okay, they can only do so much with what they've got. And that's what they're looking at here. The paragraph here says, see, managers of a business has to consider a choice between two or more competing strategies. Okay, so if I'm selling furniture, not all those items are going to sell. We need to produce the items that sell maybe the most. Okay, or maybe the items that are most popular. And that's what we're trying to do here. So I don't know how you want to describe that. It's more business than accounting. All they've done here is they've just analyzed every separate unit. What you can do there from an accounting point of view is say, each item must be analyzed separately. Okay, so we could look at chairs, we could look at tables, we could look at cupboards. You could manufacture chairs, tables, and cupboards according to the market, meaning what does the market want, or you could manufacture according to what's cheapest for you as the business. Okay, so see, there's different ways of deciding what to do. Are you going to market and produce goods based on the demand? Possibly. Okay, or are you going to look at the profitability? Which item is the most profitable? Okay, if it's most profitable to produce tables instead of chairs, maybe let's just produce tables and let's just try to sell them. Whether the market wants lots of tables or little is irrelevant. See, that's the decision. See, it's competing choices. Okay, is that alright? Okay. New section. You can say production factors affecting profitability. Let's keep it short. That's a very long heading. Okay, production capacity. Production factors. Production factors affecting profitability. Okay, so what do you think can affect profitability when looking at manufacturing, production? What are some of the factors? So if you're manufacturing your own products, what would limit or affect your overall profitability?
You have to buy new machines or machines break.
Okay, so that's something separate. That's something additional. They don't talk about repairs and maintenance here. They're looking more at time. So a factor to consider would be how many machines do we have? Do you agree? How many hours of labor do we have? That's more important. Okay, so that's what they're looking at here. Okay, so as a heading, first bullet, how many machines, how many hours or people, labor, skilled labor versus unskilled. That's what they looked at here.
How many machines do we have? How many?
Comma, how many workers, employees, comma, hours in a day, time. Okay, that's the key, it's the time. Because labor is measured in time. Machines will be measured in time. So this machine can work for 24 hours. This machine can work for 10 hours, however long it can operate for.
Okay.
Okay. So you've got those two questions. Just put a note, key factors or limiting factors have the biggest influence on profits. Key factors or limiting factors. Okay, so if you've only got one machine, that's going to affect your profitability. You're going to reach a cap. You're going to reach a ceiling. Okay, with one machine, there's only so much I can do with one machine. But if I had more, then that increases the production. That increases the profitability. Okay, so key factors or limiting factors are two dots. Number one, demand for a product. That's the one factor. Okay, how would demand for the product affect profitability? We kind of spoke about it when we looked at if I produce goods, is the market going to want those goods? Do you agree? Okay, so if you're making lots of chairs and no one wants to buy them, is that going to affect profitability? Yes, so here, demand for a product is important because it limits your business. Okay, your business is only determined by how much people want to buy. Okay, so if the product is popular, great. If it's not popular, bad. Okay, that's the one factor. Second factor, resources available for production. Second factor, hours or time. Let's use time, and then in brackets you can say labor hours or machine hours.
Hours?
Bracket time, labor hours or machine hours. Okay, so labor and machine. So the machine can work for a certain number of hours. The people that we employ can work for a certain amount of hours. The amount of people we have, the amount of machines we have determines the profitability. Okay, so if we had more people, we would be able to be more profitable, hopefully. Okay, if we've got more machines, same thing as well. Okay, the last bit here, you can just say MB, factors of production. That's what you're actually looking at. And that covers that part. Okay, so here you've got penetration or destroyer pricing. This strategy is employed by the manager of the business when they wish to gain a foothold in a market in which a number of firms are already well established. They decide to cost their product using only marginal costs. They can do this because their existing customers will already be covering or absorbing the fixed costs incurred by the business. That's just a side note, and then they go cost, profit, volume analysis. That's actually important. That they'll probably ask you quite a bit on. This is popular in other subjects, other modules, other courses. So that's just theory. It's literally just one line. You can just write that down.
And yeah.
Separate, as a separate bullet. Separate bullet, separate notes. Okay.
Yeah.
Penetration or destroyer pricing. Equals strategy or destroyer pricing.
Yeah.
Okay, so what is that? You can just say a strategy to gain a foothold in a market. That's why it's used. Okay, that's like launching a new product. Okay, if you're launching a new product, you want to take as much market share as you can from the market. Okay, so if you're, okay, let's even relate it to this. If you're
To gain a foothold
in a market. Okay, so this is a market that you're trying to gain a foothold in. Right, so you could price your services or products competitively so that you get the client over your competition. Okay, that's what it's looking at. Alright, the last part of this chapter is looking at CVP, cost, volume, profits. That's a totally separate working altogether. Okay, that you can put on a big heading, probably on a new page, I think, because there's a lot here just for this one section. Okay, let's see, there's 1, 2, 3 formulas. 3 formulas and some theory, and then that covers this chapter. Right, CVP, cost, volume, profit analysis. Okay, so those 3 words relate to what we're looking at. Cost is how much does the production cost us in terms of expenses. Volume is how much do we manufacture. If I manufacture more, it's going to increase the cost. Okay, that's why it's volume. Cost, volume, profit analysis. Looking at those 3 key areas. Okay. You can also say often called break-even analysis. So another name for it, break-even analysis. I think this you might even have covered in business. Hey, break-even. Seems very familiar. Were we at fixed cost over contribution? Yeah, it's actually exactly the same. Okay, even marginal safety, we've spoken about these things, yeah. Okay, break-even analysis. First heading, contribution per unit. That's the first formula. Okay, contribution per unit equals selling price minus variable costs.
selling price minus
variable costs or costs. There's a few. Okay, underneath variable costs, let's list them. Okay, the first one, direct material, then labor, and then fixed costs. Fixed costs shouldn't actually be there because fixed cost is a fixed cost. Okay, but I see they've included it. So let's change it to variable costs.
direct material.
Right, direct material. Let's just use direct material and direct labor, just those 2. Now you shouldn't be putting fixed costs here because it's a variable cost. Okay. So if I use an example, or let's write down the formula first before we look at the example. You've got it. Let's write down the other equation, break-even point, second one, and we'll do one example that covers all of it.
Because is this the next one now?
Yeah, so you've got contribution per unit, new heading, break-even points. Yeah, that's 1, this is 2, break-even points. How do we calculate break-even point? The formula is numerator and denominator. Numerator, fixed costs, total fixed costs, everything. Divided by, so denominator, contribution per unit, which is the equation that we looked at earlier. Okay, the contribution per unit, which is equation 1 basically. Contribution per unit. Okay, those are the 2.
Okay.
Right, so let's do this one. Let's use this as an example. Okay, we'll use the small numbers. Yes, but the third one is looking at where is it? Marginal. Where is this? That's the graph. The units to be sold to reach a target profits. This is contribution to sales ratio. It's something a little bit different. So these are the two that go together.
Example?
Okay, e.g., direct material 23. Maybe just write down per unit, PU. Direct material per unit 23. Direct labor 17. Selling price per unit 75. All of this is per unit. PU, PU, PU. This one was 75. Okay, let's calculate. So, number one, calculate the contribution. How much is it?
Times 3 plus 17. Minus 15
is? Okay, but remember it's per unit. All of these amounts are per unit. Okay, so you've got the contribution. Right, next line you can just add to the question, assuming fixed costs totaling 54,000. Assuming fixed costs equal 54,000. This is part of the question. Okay, assuming fixed costs are 54,000.
But we're not using thousands, so we must just say 54.
No, 54,000. 54,000 because that's total. That's not per unit. See, that's total. You can maybe say next to that total fixed costs. Okay, so what are the fixed costs? 54. What is the contribution? 35. So let's calculate break-even point. BEP, break-even point, equals, what's the formula? Fixed cost, how much? 54.
54,000?
Yes, 54,000. It's fixed cost, everything. Divide by contribution per unit.
So it would just be 35.
Gives you how much? What's the answer?
1542.
Comma? Okay, so with break-even point, no, okay, it's units because break-even point is how many units you're producing. Okay, 452,8, 5. Is it possible to create a fraction of a unit? No, I can't produce half the product. I either make the whole chair or I don't. I make the whole table or I don't. Okay, so you have to round this up or down? Up. Okay, so break-even point for this business would be 1,543 units. That's how much they would have to sell to break even. Okay. A little bit of revision. A lot of this is business, eh? Okay. The last two formulas here, 3 actually. No, you've got this one. Okay, the break even you've already got, so last 2. Okay, you just put a heading here. 2 other equations. Number 3, if you want to label it, units to be sold to reach a target profit. Units to be sold to reach a target profit.
Units to be sold
to reach a target profit. Okay, the formula is there's a numerator and there's a denominator. Okay, the numerator is quite long. There's 2 components. The numerator is fixed cost plus profit required. That's the numerator. And then all of that must be divided by a denominator, which is contribution per unit. Okay, that's the denominator, and that's the formula. Right, so if a business wants to know how much they need to target to make a certain profit, they need to work out this calculation. Okay. And that'll tell them how much they're going to produce. Okay, I don't want you to write this example down because it's very simple, but just look at this one. Okay, in this example, how much fixed cost does the business have? 60,000. Okay, what's the selling price? 56. What's the cost price? 32. What's 56 minus 32? Can you work that out? 56 minus 32. 24. What is 24 representing? The contribution. Okay, so that's what you've done always. All we have to do here is just add the profit. So how much profit does this business want to make? 80,000. Do you see that? Okay, so what do? We take the fixed cost, we add 80,000 to it, like they've done there, divide by 24. That's all. It's the same formula, just with profit being added to the actual working. Okay. Right, number 4. Okay, you've got that equation. Contribution to sales ratio. Contribution to sales ratio equals total contribution divided by total sales revenue. That's the formula. Total contribution divided by total sales revenue. Numerator, denominator.
Divided by?
Total sales revenue. Okay, that's the formula, and that's that. I don't know if you have to draw graphs. I don't think so, because this is accounting, not business. You might, depending on the past papers, we'll have to see. The rest is just drawing the graphs. Okay, straight line and XY axis there. Okay, so maybe just to add to that, you can just say CVP. Yeah, CVP, cost volume profit, can be drawn. Let's just reference it. You can say see page 318. Cost volume profit can be drawn as a graph.
See page?
318. Okay, that's that. Oh, a little bit more theory. Sorry, one more thing to add there. I see this on the last page. Sensitivity analysis looks at multiple variables when forecasting amounts. Okay. Sensitivity analysis focuses on multiple variables when forecasting. Focuses on multiple variables when forecasting. Forecasting, maybe you can say income and expenses. Okay, both are being looked at here.